SCHD, DGRO, and VYM are some of the most popular names when it comes to dividend ETFs. Not only are these funds going to be paying you some nice dividend income, but they each have their own unique strategy. And in this video, we're going to be taking a deep dive and comparing each of these 3 ETFs to see which one stands out from the rest, and to help you decide which one will work best for your goals and your portfolio. Let's get right to it. First, so you can get a better understanding of these ETFs, we're going to be getting into the strategies and objectives of each. Kicking it off with DGRO, the iShares Core Dividend Growth ETF. This fund seeks to track the Morningstar US Dividend Growth Index, which is made up of stocks that have a history of consistently growing their dividends. And there's a few criteria that this fund screens for. First is that companies must have a minimum of 5 years of consecutive dividend growth. REITs or real estate investment trusts are excluded. Their dividend payout ratio must be less than 75%, and the payout ratio is just the percentage of a company's earnings that are paid out to shareholders. It also excludes the top 10% of the highest yielding stocks. Next is SCHD, the Schwab US Dividend Equity ETF. SCHD tracks the performance of the Dow Jones US Dividend 100 Index, which is just an index that focuses on high-quality dividend stocks. SCHD screens stocks based on a few criteria. Companies must have 10 years of consecutive dividend payments, a market cap of at least $500 million, a minimum average daily trading volume of $2 million, and there's also further filtering taking into account 5-year dividend growth rate, return on equity, indicated annual dividend yield, and more, ultimately leading to the final stock selections with a 4% cap per stock and a 25% sector cap. Third up, we have VYM, the Vanguard High Dividend Yield ETF. This fund tracks the FTSE High Dividend Yield Index, which includes companies that offer high dividend yields. There's also a few things that this fund looks at in its screening criteria. It screens for stocks in the FTSE USA Index based on their projected 12-month dividend yield, and companies that do not pay a dividend and are not expected to pay a dividend in the next 12 months are excluded. REITs or real estate investment trusts are excluded as well. And the fund picks stocks with a dividend yield above the 55th percentile, and the stocks are weighted by their market cap. Now that you know what these funds are all about, let's compare them to see the strengths and weaknesses between them. And in order to do that, I'm going to be ranking these ETFs on a point scale from 1 to 3, with first place being worth 3 points, 2 points for second place, and then last place or third place is going to be worth 1 point. For the first category, we have diversification. And this is going to be the holdings and the sectors that these ETFs are exposed to. Starting with DGRO, this fund contains a total of 416 stocks, with its top holdings in companies like Microsoft, JP Chase, Exxon, Johnson & Johnson, and Apple. The top sectors that make up DGRO include financials, technology, and healthcare. As for SCHD, this fund holds 103 stocks, so a bit lower here, and it has top holdings in Coca-Cola, Verizon, ConocoPhillips, Pepsi, and Home Depot. The sectors that make up SCHD include consumer defensive, energy, and healthcare. After the recent yearly reconstitution, there was a bump in energy exposure as well as consumer defensive, which are now at the top. Last, we have VYM, which contains 592 holdings, which is the most out of the bunch. And its top holdings include Broadcom, JP Chase, Exxon, Walmart, and Procter & Gamble. And it has exposure to sectors such as financials, industrials, healthcare, consumer staples, and a few others. So when it comes to diversification, I'm gonna have to give third place to SCHD. It just holds a lot less stocks compared to the other 2 ETFs. And second is going to be DGRO, because not only does it fall a bit short compared to VYM and total stocks, but VYM has a better spread in those top sectors as well. For this reason, VYM is going to be taking first place for diversification. Next up, let's get into risk. While dividend ETFs are typically less volatile than broad market and growth ETFs, that doesn't make them immune to risk. One of the first points I want to get into when it comes to risk is beta. Beta is the measure of the volatility of an investment compared to the overall market, and the S&P 500 is the standard when it comes to this. The beta for the S&P 500 is 1, so anything with a beta above 1 is going to be more volatile and carry more risk, and a beta below 1 is going to be less volatile and less likely risky. If we take a look at the beta over the last 10 years, DGRO has a beta of 0.89, SCHD has a beta of 0.87, and VYM over the last 10 years has a beta of 0.85. There isn't a huge difference between the three, with SCHD squeezing in the middle and VYM being at the top here as the ETF with the least amount of volatility. The second part to consider for risk is the percentage of the assets in the top holdings for these ETFs. So basically, what percentage do the top 10 stocks make up out of the entire ETF? For percentage of assets in the top holdings, DGRO has 26%, for SCHD he has 41%, so a bit of a difference there, and VYM has 25%. When it comes to the beta, these funds are pretty close, but as for the top holdings, it's really only SCHD that stands out a bit more. But I also want to consider for these ETFs the risk of their sectors and holdings and the points for this section. So last place is going to have to be DGRO. While its top holdings were close to the lowest percentage amount, its beta is the highest, meaning it does carry more volatility. Also, you do have to consider that DGRO has a decent chunk of exposure to tech stocks, which in downturns or uncertain times is much more vulnerable to declines. And second is going to be SCHD. It was second in beta, and while this is a great fund, it does have quite a bit more percentage in those top holdings compared to the others. Also, with the new increased exposure to energy, it does make it a bit more susceptible to taking a hit here when oil demand is affected in times of a recession. This leaves first place for VYM as it has a lower beta along with the lowest percentage of assets in its top holdings. The third category is going to be dividend yield and growth. So we'll be comparing how these ETFs hold up against each other when it comes to their dividend yields and their dividend growth over time. If you don't already know, dividend yield is how much a company pays in dividends in relation to its stock price. Let's say a stock has a price of $100 and it pays dividends yearly of $3. This would mean the dividend yield is 3%. Now that we've got that, let's get into the first ETF, DGRO. This fund has a dividend yield of 2.3%, which is dividends are paid out quarterly. As for dividend growth, it's had 10 years of consecutive dividend growth with a 5-year annual dividend growth rate of 7.6%. Next up, SCHD has had a dividend yield of over 4%, and its dividends are paid quarterly. And SCHD has had 13 years of consecutive dividend growth with a 5-year dividend growth rate of over 11%. Last is VYM with a dividend yield of around 3%, which it also pays quarterly dividends, and VYM has had 14 years of consecutive dividend growth with a 5-year dividend growth rate of 1.6%. Since dividend yield and growth are two different metrics, I'll be rating them separately. So for DGRO, it's going to be coming in last for its dividend, and for growth, it'll be taking second place. DGRO comes a bit short on the dividend yield, but it has some pretty nice growth, which this should be expected because this fund focuses on quality stocks that grow their dividends rather than those that pay the highest dividend yield. For VYM, it's going to be coming in second for its dividend yield and then third on growth. As the dividend yield is pretty good, it does lag dividend growth by a huge chunk compared to the other two, which I believe is partly due to its screening strategy. This leaves first place for both dividend yield and growth for SCHD, given its focus on high-quality dividend stocks that give you a great combination in both yield and growth. The fourth category is expense ratio. Expense ratio is the cost that the fund charges to cover their administrative, management, and other operating expenses. Starting with DGRO, it has an expense ratio of 0.08%, which means you'd be paying $8 for every $10,000 that you have invested. SCHD comes in a little bit lower with an expense ratio of 0.06%, and VYM also has the same expense ratio of 0.06%, which would be $6 for every $10,000 that you have invested. I think you may know already who's going to be coming in third here, and that's going to be DGRO with this expense ratio of 0.08%. It's slightly higher than the other two, but all these ETFs have very low fees, which is good news for you. And since both SCHD and VYM have the low expense ratio of 0.06%, there won't be a second place, so I'll be giving them both 3 points for first place. The next category is going to be performance. Now, we're going to be comparing the price appreciation in the past performance of these three ETFs. Kicking it off with DGRO, this fund has had annualized returns of over 16% in the last 5 years and around 11.5% in the last 10 years. Meaning if you had invested $10,000 in DGRO 10 years ago, your investment would now be worth almost $30,000. SCHD has had annualized returns of 17% in the last 5 years and around 11% in the last 10 years. And last, VYM has had returns of around 16% in the last 5 years and just under 10% in the last 10 years. To give you a better idea of how these ETFs compare to each other, let's take a look at some charts. Looking over the past 10 years, we see that while DGRO did outperform SCHD, it wasn't by that much. And for a couple of years, SCHD was ahead. Zooming in closer at just 1 year, we see that VYM is handling some of this market volatility better than the others. And SCHD coming up shorter here due to the sectors of some of its larger holdings like energy taking a hard hit. Getting to the scoreboard, when it comes to returns, I'm going to be putting VYM in third here. It definitely falls short on the side of appreciation when compared to the others, while it does have more holdings and it's a bit less volatile. And second is going to be SCHD. While it has had some solid historical returns, given its great dividend benefits, DGRO will have to take first. The fact that DGRO is exposed to growth-oriented stocks, it gives it the edge for future growth potential compared to the others. After going through all the categories, let's see how these ETFs compare to each other. After adding all the scores up for all the categories, we have DGRO in third place with a total of 10 points, VYM in second place with 13 points, and taking the title here in first is going to be SCHD, the Charles Schwab Dividend Equity ETF. These are all solid dividend ETFs if you're looking for an ETF to add to your portfolio. And if I could only choose one out of these three dividend ETFs, I'd be leaning more towards SCHD, but that's just me. Determining what your strategy is for your portfolio and your goals with dividends plays a big role in which dividend ETF may be best for your portfolio. So choose what works best for you. And if you want to see more choices on some solid dividend ETFs, be sure to check out this video here. Or if you want to see some great monthly paying dividend ETFs, take a look at this video here. If you haven't already, be sure to tap that like button and subscribe to see more content like this. I really appreciate you watching, and I'll be seeing you on the next one.